The market are driven by liquidity irrespective of how well the economy does. The same is case for India. Yes, we are the most expensive market globally because of the potential to grow and for economic fundamental. Today I will take you to the major indices and to the US interest rate, liquidity and positions. Starting with Nifty index, due to global market sell-off, we may see Nifty to touch 24,400 to 24,100. The most important level is 23,900 because of Fibonacci level. If the market goes below, it might touch the level of 23,300. The earning of Nifty 50 stocks is not been impressive considering the index trading at 23 times trailing PE. Therefore, I believe that we may see a healthy correction in the market. Let's now talk about the Bank Nifty Index, where major banks continue to face selling pressure at higher levels mainly because of FIIs keep selling. In HDFC, ICICI, Axis Bank, they have around 40% of the stakes. Therefore, the banking stocks are underperforming the broader market. The key level to watch out for these are 50,400 level. Let's talk about the favorite sector as of now. First one is energy, where we have to keep focus on ONGC, Coal India, and Power Grid. The another sector is FMCG, where we have to take care of ITC, Jyoti Labs, and Britannia. The other sector is pharma sector, where we have to keep an eye on Pfizer and Venus Remedies. Now let's look what is happening globally. There are a couple of things happening together which didn't happen in a decade. Let's discuss it one by one. The first one is Fed keep its interest rate unchanged. Economic data print is not good enough and bond market is discounting rate cut. Let's look into the chart. This is 2-year US government bond yield. It has fallen by 10%, nearly 50 pips in last 3 trading sessions. The 10-year bond yield has fallen close to 35 pips. This is basically telling that the market required Fed to reduce the interest rate which they are supposed to do in July but kept it unchanged. The US is also fearing recession which is further escalating the need of rate cut. The second is to discuss the Japan interest rate policy. The Bank of Japan raised interest rate of 15 bps to 0.25% in the second hike this year and announced a plan to taper its bond buying. Traders expect more rate hikes to come this year as Japanese central bank tries to reduce inflation. This means reducing liquidity in Japan. The main question is, why is Japan important for liquidity? For last 30 years, Japan has zero interest rate. As a result, for last 30 years, investors borrowed in yen at no cost and invest in globally. For the first time in many years, Bank of Japan increased the interest rate. As a result, investors are concerned about the money they borrowed for free is no longer free and therefore they are unwinding their position and sending back the fund to Japan, causing the liquidity to flow in the Japanese market, which may lead to appreciation in Japanese currency pegged with US. We may see a fall in US in comparison to JPY in these charts clearly. This was the whole discussion for today. If you learned something new, please hit the like button and subscribe button. Thank you. Have a great day.